An S corporation election requires something called an 1120S, which is a bit of a more complicated return, which most tax professionals will charge a bit more. So on average, that could be anywhere from $1,500 to $2,000 for filing an 1120S return. You want to make sure that the tax benefits of electing an S corporation outweigh the costs of operating it every year.
One of the things that you actually said is that the holdings company should be an S Corp. Now, is that applicable even if we're just starting off?
It is the aspiration for the entity, not the requisite at the beginning. Typically, you do not elect S corporation tax treatment until you have sufficient taxable income to justify all of the expenses of doing so. What do I mean by that? The number one expense of an S corporation is the cost of tax preparation services. When you're filing a return for an LLC that, let's say, is a partnership, like two-member LLC, multi-member LLC, well, that is a 1065 and typically is charged a bit less than some other business entity returns. If it was a single-member LLC, that is disregarded for tax purposes, that's going to result in simply a Schedule C to be filed, which is even lower cost structure. But an S corporation election requires something called an 1120S, which is a bit of a more complicated return, which most tax professionals will charge a bit more. So on average, that could be anywhere from $1,500 to $2,000 for filing an 1120S return. So what you do from a calculus standpoint is you want to make sure that the tax benefits of electing an S corporation outweigh the costs of operating it every year, right? The filing of this different type of return. And usually that happens once you start getting into the $50,000 net taxable income range. That's not $50,000 of revenues. That potentially could be $125,000 of revenues, and after expenses, you're at $50,000 of taxable income. Or it could be $500,000 of revenues, and after expenses, you're at $50,000 of taxable income. So it's going to depend on your individual circumstances. But typically when you get into that range, it starts to justify the expense of the S corporation. Now, there are other potential speed bumps in that decision-making process as well. There's another aspect of the tax code called QBI, qualified business income. And in that environment, there's also a tax deduction. But when you're an S Corp, you don't get the full QBI deduction, right? Because a portion of your compensation is going to come to you in the form of reasonable salary, and reasonable salary doesn't get a QBI deduction. It reduces your exposure to QBI, but also reduces your exposure to self-employment. So you have to do a little bit of calculus. That's why I say a general rule of thumb is about $50,000 of taxable income. But the higher that number gets, like $100,000 of taxable income, $200,000 of taxable income, well, then it just becomes a no-brainer. Yes, in every circumstance, that holding company on the non-passive side is going to elect S corporation tax treatment in order to reduce your exposure to self-employment tax. But again, it is a bit of a nuanced decision. And if you're just starting out, zero revenues, you're not going to elect S corporation treatment in the beginning. It's just going to be a partnership return, a 1065, and that income will be distributed to its partners, which would be the LLC members, which are the trusts, which are essentially you, and that information gets reported to you via K1.
There was another question in there because my husband and I filed jointly, whether it's a single or a multi-member LLC.
Correct. But if the holding company, if you follow our matrix and the way we teach, the holding company is actually owned by your individual trust and your spouse's individual trust. So those trusts are members of the multi-member LLC. That multi-member LLC will file a tax form called a 1065 and will issue two K1s, one K1 to you, one K1 to your spouse, and those respective K1s get reported onto your 1040 Schedule E. That's the joint return that you file as a married couple filing jointly. So you're filing a 1065 for the business and a 1040 as for your personal, and the business income is going to be reported on your 1040, but specifically on Schedule E. of your 1040.
So that doesn't matter even if, because back then we were W-2 and we were about above the 300 threshold, because now it's passed through.
Imagine for a moment you were previously W-2, so that W-2, that reporting document, found its way to your 1040. The same thing is going to happen, but instead of a W-2, you get a K-1. And your K-1 is going to report your business income. But instead of that just showing up on your 1040 page 1, it actually first goes to your Schedule E, and then your Schedule E sends it to the 1040 page 1. It's the same thing. It's just instead of a W-2, which a company will pay to its employee, you as a business owner of a partnership will receive a K-1.
Thank you. And I set up actually a call just to visit the coaching aspect of this, because I think it's better to be set up right early on.
The promise that we have here at Uplevel Entrepreneur is that we're looking to help business owners become Uplevel entrepreneurs. The process of an Uplevel entrepreneur is really 3 different characteristics. 1, you have your right business structure in place. 2, you know how to operate that business structure. And 3, you know how to keep more of every dollar you make. And if you have those 3 characteristics based on our definition, you are an Uplevel entrepreneur. Now, you could do that on your own within just the content that's available in the community, right? That we have a lot of individuals that are very much do-it-yourselfers. But for some, they want a shortcut to their journey. So that's why we have the coaching and consulting environment. And in that, it's the same promise. We help business owners become up-level entrepreneurs, but we do so in 90 days. That's the shortcut, right? Within 90 days, you have your business entity set up, you have your operations set up, and you know how to keep more of every dollar that gets made. That's essentially the promise of community inside of the coaching and consulting environment. Now, there are 2 different levels of coaching and consulting as well, right? We have the standard approach, which is that 90-day promise. We also have a higher level coaching environment where we actually build the infrastructure and deploy it in your ecosystem, right? We have VAs that we deploy into your business to help you manage all the operations and make sure that you're keeping track of all your corporate minutes and you're scheduling your Augusta rule meetings and you're doing all the stuff, right? We have the done for you aspect that's part and parcel to that process. But again, the overall up-level community, it has a unifying promise. We help business owners just like you become up-level entrepreneurs. If the topic of holding companies intrigues you and you'd like to learn more about it, I actually put together an entire course inside of my private membership community that goes into all the details. If you want to take your life and your business to the next level, go ahead and check out the link in the description below.